Welcome to Animal Spirits with Michael and Ben. You prepared me you were ready to take the other side on interest rates for me. So we've got a lot of questions on rates lately because they're finally running a little higher. There was almost a little flash crash up in interest rates, which would be the bond prices falling last week. I think it went from like 1.5% to 1.6%, and everyone lost their mind. 10-year treasuries finally rising.
I think it was more than people losing their mind. I think some funds were actually blowing up.
Yeah, so a lot of people, the original thought is, okay, we have all this government spending. People are worried about inflation. The economy is getting ready to heat up and potentially go berserk in the summer from people's pent-up demand and spending. And so it makes sense that bond yields are rising, but hey, what happens if it gets away from them here? And that's the first big worry. And then you had Tracy Alloway from Bloomberg come in and say she thinks, JP Morgan is saying maybe it's these CTAs that are rebalancing. And I'm really latching onto her flows over pros thing, where people worry about the data and what's happening in macro and all these things. But really, most of the time when things go a little haywire in the markets, it's because flows are moving things around more than actual market dynamics. So this is basically could have been, you had this big jump in rates because it was all these technical traders that were moving things around because they hit their rebalance bands or their trading signals hit and they were selling bonds because the momentum's not there anymore. Obviously, it's probably a little bit of all these things, but that's the stuff. And now, of course, people are worried. Bonds are going to get crushed. They're off to a pretty bad start to the year. I looked last week. The long-term Treasury TLT ETF was down 18.5% at one point from highs. So almost a bear market for long-term Treasuries. And I said, okay, interest rates matter. But then I wrote a piece this weekend where I said, but do they really? Like, are interest rates the be-all, end-all that people want them to be? Because people think the only reason stocks are up for the last dozen years is because the Fed has kept rates low, and so that's the only reason that risk assets are on fire. Because
I think you're putting thoughts in people's mouths. Nobody's saying that.
I think there's plenty of people saying that interest rates are driving crazy behavior. And my point is just maybe we overrate the importance of interest rates. So I went through a bunch of examples. You can read my piece, but you had the 1960s, you had the go-go years where growth stocks went crazy. Inflation was rising, rates were rising the whole time. Average 10-year treasury yield was over 5%. The dot-com bubble, average 10-year treasury yield, 6%. You could have gotten 6% on your money at the end of the dot-com bubble, and no one wanted it. Maybe sometimes investors just need an excuse to sell. We had this little, 2.5 day correction, and then now everything's fine now. We're taping this on a Monday. I don't know. And the other piece is, getting back to the flow thing, at what point do pensions and insurance companies and retirees and sovereign wealth funds step in? Because people are now worried, rates are going to go straight to 6% here. And I think people are getting a little ahead of themselves. So I'm just saying, yes, rates matter, and probably from more of a psychological perspective now than anything, but people don't need interest rates to go crazy and gamble and invest in lottery ticket style stuff. People aren't trading options on margin because interest rates are low right now. Is that one piece? Yes, but is that the whole piece? Not even close.
I feel like we've had this discussion a million times. But how about this? One of the reasons why there is a favorable market environment is due to low interest rates, right? That's not controversial. That is clearly one of the reasons.
Yes.
And then in a market environment where the wind is at your back, where risk is rewarded, people take it too far. Am I saying anything controversial?
I don't think so. But I'm going to go out on a limb and say this pandemic happens and rates were 5%. I think we still get a crazy speculative boom regardless of the level of rates.
Okay.
They added a little fuel to the fire, but that fire would have been raging either way.
Here's where I'll take the other side. I do think it's possible. Well, it's funny. I just wrote a quick piece that Sarah Ponczek had this really cool chart showing that companies with weaker finances staged their best relative run since 2009. So in my mind, this is where it gets sort of muddy, and maybe the value growth thing should just be thrown out the window. When I see this chart, I think of cyclicals. I think of industrials, materials, energy, financials. These tend to be value stocks, right? Somebody tweeted to me like, well, don't growth stocks have weak balance sheets? Maybe, but I think that this chart in particular is showing weak stocks with weak financials, weak balance sheets outperforming. It was basically the inverse of what we saw in 2020. In 2020, if you had a weak balance sheet, you got murdered, which makes sense, right? If you have a weak balance sheet in a pandemic, when there's zero economic activity, that's not good. So the reverse has happened. And so if higher interest rates are bad for growth stocks, then shouldn't they be doubly bad for the Carnival Cruises of the world?
Right. And the one thing people say is like, well, the reason it's different this time is because all these firms have more debt now. And if rates rise, they're screwed. It's like, guess what? The bonds they sold have already been sold. And if these companies were fine on 3% interest rates 2 years ago, what's going to make them put them in such peril if rates go back to 3% now? Like, I think companies can adjust. They always do.
Here's where I said I'll take the other side from you, is that if enough people believe that high interest rates are going to crush growth stocks, then that could be a self-fulfilling prophecy, right?
I agree.
Where if people start to sell because that's the narrative, like the more we hear a narrative, even if it's not true, but maybe it is, but even if there's a kernel of truth and people believe it, then it could become true. Do you agree with that?
It's the George Costanza. It's not a lie if you believe it.
Jerry, just remember, it's not a lie if you believe it.
Do you agree with that?
Yes, I think that's my point, is that it's probably psychological more than anything. If people are like
So how about
anchoring to 1% interest rates or whatever they were, and then they say 2 and they go, oh, this is crazy. But I mean, do you think interest rates going from 1% to 2% is going to make Apple or Amazon business any worse?
That's not the point.
I know, you're right. It's right. Could that take people's PE ratios from 50 to 30?
Yes.
Yeah, that's again,
but you know what's
psychological.
interesting? So let's just assume that rates rise, which is far from a given, but let's just grant that happens and growth stocks do get killed. We still won't necessarily be able to make the link that it was rising interest rates that did it, because it's not the only part of the formula.
Exactly. There's so much more to it. So my other one was from 1975 to 1985. Mortgage rates averaged 12%.
People still bought houses.
The baby boomers came online. Guess what? Housing prices were up 133% in that time because demographics overwhelmed those ridiculously high interest rates. So it's not all, like people say, oh, well, the Fed is propping up the housing market too. Guess what? Millennials are getting older and buying homes. They would have bought
interest
homes.
Interest rates are not destiny. Demographics are.
Yes. So millennials would be buying homes whether mortgage rates were at 3 or 5% right now. I can guarantee you that. When we bought our first home, our mortgage was 6.25. I guess in your terms, that would be 6 1/4.
Six and a fourth. A fourth. Sorry.
6 2/8. We were going to buy a house regardless of that interest rate. Now, maybe that determined what kind of house we could get and the size or whatever, but I think that's something that a lot of people don't spend as much time worrying about as financial pundits do.
All right. So we were talking last week that maybe demand from pensions, retirees, et cetera, can put a cap on interest rates. Did you read, like, in other words, they're salivating at 2%. It's just too juicy to pass up.
Right. And that's the other side of the psychology where they think 2% is high now.
Did you read the Buffett letter?
I did. I mean, this has got to be like the least amount of fanfare ever for one of his. It seems like it's kind of, I mean, he's 90 years old, right? So it's bound to happen eventually. It seems like it's kind of run its course. Like, this is the kind of thing where 4 or 5 years ago, the FinTwit would just be blowing up with stuff about Buffett. And now it's kind of like, oh yeah, Buffett has a letter today. I forgot.
Yeah. I still liked it. I understand why people were sort of mad on it. I mean, there wasn't anything quote unquote new in here, but it was just maybe a reaffirmation of his teaching. So I enjoyed it. But he said,
how much do you think he's still doing at 90 years old?
I don't know. I mean, I think he's still writing this with Alice Schrader. Oh wait. Did they break up after the snowball?
Oh, I
think they did.
That's a good question. I mean, he's still like, the letter came out. I thought it was great, and it reminded me of one of his old ones for sure. But yeah, it's just weird how it seems to. I mean, maybe that's a sign of the times too. Even if he was wildly popular like he was in the past, people wouldn't care as much because it's not his type of environment.
Anyway, so he wrote, fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future. And take a look at this chart. I pulled this up. Mobison did this chart on the asset allocation from U.S. pensions and endowments. And look on the right. Look at this chart. Fixed income and cash. It's not much. It looks like I'm just eyeballing it. It looks like there's under 15% of their portfolios are allocated to fixed income. Yeah,
and it used to be that they basically only invested in fixed income and equities were kind of the thing you didn't touch.
This goes back to 1990. In 1990, they had 40% of their portfolio in fixed income. Now, like I said, it's just over 10.
Right. Yeah, that's
obviously that's a function of rates falling and alternative assets just exploding in their portfolio. The last 2 years have not been kind to Berkshire Hathaway. Last year, the S&P was up 18%, Berkshire was up 2%. The year before that, the S&P was up 32%, Berkshire was up 11%. Do you think it's fair to compare the returns of Berkshire Hathaway to the stock market as opposed to looking at his actual investments?
No, I think it's perfectly fair because that's a huge company. It's diversified, and I think the fact that they were given a premium in the past to book value, and now maybe that premium's coming in. I think that's completely fair. And he even compares himself to the S&P 500, right?
So why am I struggling with this? When people say like Buffett hasn't beaten the S&P 500, in my opinion, and I could change my mind on this, but should you not be comparing, if you're going to say that, should you not be comparing his stock picks versus the S&P 500? Obviously, I see both sides. I'm just devil's advocate.
Okay, but I mean, that's his goal is to beat the market, though, right? I think that's his kind of stated goal. I don't know. We're splitting hairs here. The craziest thing to me out of this whole thing, you put it in here, was so they have a 5.4% stake. They own over 5% of Apple, which has done extraordinarily well. That should have helped. And I think they've like quintupled their investment in that.
Their cost is $30 billion. It's now $120 billion, and it's their second biggest asset. That shocked me.
And they only bought it in 2015. And
no, I think 2018. Is that possible? Or 2016?
Yeah, maybe. But and then he talked about how the fact that just from Apple doing buybacks alone and them doing nothing else, they get like $775 million in dividend payments. I can't remember if it was per year or per quarter, but it was a huge number. And Apple's buybacks took their position from like 5 to 5.4% just from Apple doing buybacks.
I think this is probably a simple explanation for why the Berkshire Hathaway stock has not done well over the last 2 years. Really, over the last, it's been longer than that, but really over the last 2 years. Buffett wrote, Berkshire owns American-based property, plant, and equipment, the sort of assets that make up the business infrastructure of our country. With a gap valuation exceeding the amount owned by any other U.S. company, Berkshire's depreciated cost of these domestic fixed assets is $154 billion. Next in line on this list is AT&T, with property, plant, and equipment of $127 billion. So they're a capital-intensive business, and obviously that has been out of favor, to state the obvious.
Right, so they still have tangibles, and everyone else that's been doing well is intangible, basically.
To me, the overarching message of his post was really don't bet against America. He wrote, in its brief 232 years of existence, however, there has been no incubator for unleashing the human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking. And that's the takeaway every time I read him, is just we pay so much attention to the day-to-day, but take a step back and there are some marvelous things happening in our country, and not just on the coasts, which he mentioned.
That's the best thing he's done in terms of communicating to the regular investor, is having a long-term mindset and being a long-term bull on the country and people getting better. Where then you hear this other stuff, people just constantly negative and looking for the downside. He doesn't do that.
There was a chart from Ben Breitholtz, showed all of the instances where the U.S. 10-year broke out to a new 6-month high since 2000. And you go back to 1994, obviously there was a huge year for interest rates. January 2013, 1999. Go down the list. These are not bad years for stocks.
Right. The history shows that rising rate environment stocks tend to do fine.
Because why are interest rates rising? In theory, because of the prospering economy. It's usually that simple. The other day I wrote a post called Everything is Oversubscribed. And I forgot to include this part. So this happened, I think this was before the Treasury explosion. 2-year notes were sold at a premium for the first time ever. And this quote, Ben, is just the coup de grace. Somebody, Glenn Capello, said, when the Fed's committed to keeping rates at or near zero, 2s are probably cheap at 10 basis points. It's a little crazy. It's a little crazy that you have to buy them at that yield, but that's your choice. 2s are a little cheap at 10 basis points. Good Lord.
Well, here's the other thing that we didn't talk about. So if the rest of the world, a lot of the rest of the developed world has negative rates, and the U.S. gets up to 1.5, how great does that look when they're seeing rates over here and other countries come in and buy them too? So that's why it just, I don't know. This is why you get a 2-day little correction in the stock market, and growth stocks, to be fair, a lot of growth stocks got whacked pretty good, and people bought.
Like Tesla was down almost 30%. There was a lot of carnage.
And guess what? People stepped in and bought, and I just think that's going to be the MO for a while. Like, I think that's just the way it's going to happen for a while with this stuff for rates and for stocks.
By the way, I'm creeping more and more into this camp that this is just going to go on for a lot longer than most people think. I've been writing about like, what if this ends badly? What if this doesn't end badly? I don't know. I'm having some internal struggles, but I feel like this can last a lot longer.
I think we have to define ends badly too, because it ended badly in March when stocks fell 34% in 4 weeks.
Right. Yeah. What do you call that?
Right. So couldn't we? That happened in 1987, and then you had you had a recession in 1990 that was actually worse than most people remember. That was kind of a housing-led recession, and stocks didn't fall that much that year, but that was actually kind of a nasty recession. Like the economy definitely did way worse than the stock market for that one. And then you had this time when things just kept going, and man, you don't want to say that, but yeah, could we experience these other 19 or 20% corrections, or even a 30% correction that happens really quick, and then people step in to buy, and then back? Like, I think ends badly means like you have like an 18 to 24 month drawn out bear market. That was 2007 to 2009.
Oh, I think longer.
Or 2000 to 2002. That was, I don't think, honestly, maybe I'll regret this.
Say it.
I don't think we're going to have these longer term ones in the, like, okay, so I was going to mention this at the end in my
Hold on, before you do that, I just think when end badly, I think people mean like a 40 to 50% decline that doesn't snap back. That just sort of takes years to recover. I think that's what people mean. So, where there's just washouts everywhere and write-downs everywhere.
My book recommendation, I'll give it early, was Wealth, War, and Wisdom by Barton Biggs. It was written in 2007. Maybe it got lost because right after he wrote it that we went into a crash. But he talked about how like there was just nothing going on in the markets. No one wanted to work for them in the 30s and 40s. And he talked about how by 1937, the Dow had almost quadrupled from the 32 low, still down 60%. But he said equities in the United States and Europe sold at 5 to 8 times depressed earnings at discounts to book value and had yields considerably higher than bonds. Now, the yield thing has happened, but I think unless rates go to 15% for some reason in the future, because we have an alien invasion or something, I don't see how the professionalization of markets these days ever lets stocks as a whole trade at 5 to 8 times earnings. I just don't see how we get to those depressed levels again. Like, people want to believe, oh, we're going to hit the lows like we did in 1980 and then in 1920 or 1932 or whatever. Like, I don't see how the professionalization of markets ever lets that happen. There's no way that investors would let them get that cheap anymore, barring some sort of Independence Day 2.
Yeah.
3. No, I guess there's been a 2. It have to be Independence Day 3.
I think I'm with you. By the way, Grantham was on Patrick's podcast last week. I found him to be like delightful, which was really confusing because, my God, he's not just bearish on the next 5 years. He's like cataclysmic on the next 50.
Yeah, he's the opposite of Buffett, right?
But didn't you find him to be
Buffett.
somewhat charming?
Yeah, I've heard him speak before, and he's really good. Yeah, he's delightful.
You know what? Because there wasn't an anger in his voice. He's not like, he doesn't. I don't get the sense that he hopes things ends badly. He genuinely feels that way, but I don't think he's like actively rooting for that to happen.
So yeah, some people, and he talked about there being this just massive bubble, and he thinks it's here. Like, this is one of the big time bubbles, and he's been saying this for a while now. It was interesting to hear him say that he thinks the lack of babies coming on board, like population is going to start decreasing in the developed world. He thinks that's a problem because in 2011 he said that like we're going to run out of natural resources in the world.
I feel like that's like a 2030 call though. He's like, or 2040,
yeah.
But I feel like not to dunk on him, but you have to mention this. In 2011, they were calling for negative real returns on U.S. stocks. So it's been a decade of this, but to actually put some substance on this, the one thing that he said, because I found myself nodding along with what he was saying, right? I don't really take a hard disagree on what he's saying. But the one thing that he says that I will disagree with is profit margin. He's big into mean reversion, and profit margins have not mean reverted for a long time. Like the dynamics of our economy, of our businesses. I know, it's different this time. No, it is. It's very, very different this time.
Yeah.
These capital light businesses look nothing like companies in the 50s, 60s, 70s, and 80s. They look nothing alike. So I don't know that there's reason to think that profit margins are going to like mean revert, like there's some sort of gravitational pull on them.
I feel like he did not give enough credence to the fact that the underlying structure of the market is completely different now, which is something we talk about a lot. The other thing was, so he said, listen, this is a retail bubble. He said, in the past, and I think that's where he might be wrong, because I think he's right about that. It is a speculative retail bubble, but in the past, in the dot-com bubble, everyone was in the pool. I mean, the analysts on Wall Street were shilling for this stuff. You had the IPOs. Everyone was involved in that. That was retail to institutions to everyone. And then in the housing bubble, Wall Street was front and center pushing these toxic loans. So institutions, for those last two big bubbles we've had, institutions and Wall Street were there. This time, Wall Street's not really there at all. Institutions haven't been jumping into the deep end of the pool for this. It is a retail speculative bubble. So that's why I think, again, GameStop goes to zero tomorrow. And what does that do to the overall market? Nothing. So I think you could have the retail speculative bubble pop where some of these stocks and stuff that they're in get hit hard and they get a slap in the wrist. and it doesn't lead to a 50 to 60% correction like he's looking for. Like,
Right.
So when he says it's like one of these all-time bubbles, I disagree with him.
By the way, I mean, listen, I do see it. Of course I see the mania and I see what's going on. I don't think that this ends with a 80% decline in the overall market. I just don't. Obviously we could be wrong. I just don't see it. So Dalio did a piece also on bubbles, and these charts are awesome. So he's showing the top 1,000 companies, the share of market cap that's in a bubble. And these are proprietary. I don't know what's exactly in here, but it looks like it was about 12% of companies they defined as being in a bubble in the late 90s. We're at 5% today. If you look at the S&P 500, he had 10% of companies in a bubble then and just about under 3% now. Aren't these pretty sweet charts?
Yeah, that's pretty good. He tries to make it more quantitative. And the reason that it's so hard to predict a bubble is because so much of it is qualitative. So William Bernstein wrote about this. He gives like his 4 signs of financial market bubble, and he wrote about this a few years ago. He said, number 1 is everyone around you is talking about stocks or real estate or whatever it is. Number 2, everyone begins quitting their jobs to day trade or become a mortgage broker. Kinda.
Half a check.
3, when someone exhibits skepticism about the prospects for stocks or financial assets, people don't just disagree with them, they vehemently do so and tell them they're an idiot for not understanding things.
Check.
And 4, when you start to see extreme predictions like Dow's 36,099.
That's not happening.
But my counter to this is there's just so many more opinions today that if you're looking for the anecdotal signs of a bubble, you're going to find them whenever you want.
I got an anecdote.
Okay.
So we're doing my bedroom. I don't want to say redoing because we've been in the house for, I guess, coming up on 2 years and have not done anything to my bedroom. So we're doing it, right? We're trying to order some stuff to fill it out. And everything is on back order. And we're getting stuff from all over the place. So we're spending a little bit of money on stuff from Pottery Barn, but it's a lot of like TJ Maxx, Target stuff as well. It doesn't matter what we're getting or where we're getting it from. Everything is nothing like things are on back order until June. Okay.
So we ordered our top of our dishwasher, the rack broke in November. One of the kids was probably pulling on it and it fell. It took 3 months. I just got it last week, finally. The Wall Street Journal had this excellent article on the lumber shortage and why lumber prices are shooting up. And supposedly the bottleneck is where they're taking this lumber to be put in the mills and sent out. And so this is like the kind of story only the Wall Street Journal could write. Like the people who grow the trees. So, Grantham has been pushing timberland prices for a while. People that grow the trees aren't becoming rich because they can only take a certain amount each year because it's like 5% of the crop is taken. So the real bottleneck is at these mills where they're finishing the lumber, and they're the ones who are making out like bandits. And so because we had this supply shortage where, in March and April, people thought, okay, everything's going to slow down like a normal recession, and for COVID, the plants completely went offline, and then demand surged back, and you had all these restaurants who wanted to build decks, and you had people who wanted to build houses, so now supply is way constrained and demand is way higher. The Wall Street Journal also had this article about how there's a semiconductor shortage. And so they're having a hard time making cars because, again, most of the car lines stopped producing in March and April, and then demand surged back and people are moving to the suburbs. And Biden, I guess, is directing his administration to try to get ahead of this semiconductor production stuff. You see this everywhere. Peloton is going to invest $100 billion for the supply chain. So here's my counter trend call. What if we need to spend more money to avert inflation? People are saying, there's 2 different ways of looking at inflation, right? It's like too much money chasing too few goods. The problem right now is the too few goods, and that's because supply got constrained because, 1, people shut down their supply chains in March and April, but 2, demand came surging back way faster because this wasn't a typical recession. And so we actually need to invest more for some of these companies to speed things up. And so again, if we want to avoid just having either long delay times or higher prices, maybe everyone needs more money to get this stuff back online. Would you prefer more money be spent and we get this, because we have this huge housing shortage too. We need to build more houses.
Yes.
And so a lot of this stuff, it's the infrastructure. They need more money sent out. I'm not saying we need to send more checks to people, but we need to get the supply chain back to where it was, so where it's humming, because it got thrown offline and that screwed everything up.
But how is that a government issue? How is that a fiscal issue?
Well, when it really starts messing up with consumers and companies, that's what Biden said. This is in Bloomberg. They're addressing these semiconductor production because that can like we're so reliant on China for this stuff. Like they want to invest in the United States to do it here and produce it here instead of getting it from China.
Okay. So I wrote a post last week. Credit to me. What happens when value turns into momentum? And I ended it with, I'm interested to see what happens.
Hey, credit to me. I gave you that idea. I literally gave you the name and said you should write about this.
I forgot about that.
Quit patting yourself on the back.
Conveniently, I forgot about that. All right, credit to you. Credit to you. I'm interested to see what happens when momentum strategies start scooping up energy and financials. It feels like we're already here. And then a few days later, there was this post by Warren Pies, and they did some excellent work showing that it's actually already happening. They wrote, beginning in March, momentum funds will enter into what we believe will be the highest turnover period ever. Financials and energy will be bought. Tech and healthcare will be sold. You know what's interesting? What if this starts to affect growth stocks? And this is part of the story that might go unreported on how higher interest rates might affect growth. But this is the point. There's so many parts of the puzzle that it's never only one
it's flows. So FANG stocks relatively underperform when all the junky stocks do well. And the things that takes those small caps in energy and financials to another level is momentum traders getting in because they like the way that their charts look or whatever.
Right.